Around 70% of Americans who reach age 65 will need some type of long-term care at some point in their lives. That's 3 out of every 4 people watching this video right now. And the average cost is about $111,000 per year for a semi-private nursing home room, and nearly $128,000 per year for a private room, and those costs are rising. But the traditional long-term care insurance that financial advisors used to recommend to protect against these costs 20 or 30 years ago has essentially disappeared from the market. Most major insurance carriers stopped offering these policies years ago because they couldn't make the numbers work. There were higher claim rates, people living longer than expected, and rising care costs that forced them out of business. So if you're in your 50s or 60s and you're planning for retirement, you might be wondering what you're supposed to do. How do you protect yourself and your family from costs that could easily run $270,000 or more just over 3 years of care? That's exactly what we're going to tackle in today's video. I'm going to walk you through 3 viable alternatives to traditional long-term care insurance. We'll look at irrevocable trusts for Medicaid asset protection, self-insurance strategies when your estate is large enough, and hybrid policies with long-term care benefit riders. More importantly, I'll help you understand how to make the right decision based on your health history, your asset level, and your care preferences. And make sure to like and subscribe to learn more about thriving in retirement. Chapter 1, why traditional long-term care insurance disappeared. Let's start by understanding what happened to traditional long-term care insurance because it helps explain why we need alternatives in the first place. Standalone long-term care insurance policies were popular in the 1990s and early 2000s. The pitch was simple. You pay an annual premium, and if you ever need long-term care, the insurance company covers a large portion of your costs. But insurance companies made 3 critical miscalculations when they mispriced these policies. First, people lived much longer than the actuaries predicted. When someone buys a policy at age 55 and lives to 95 instead of 85, it's a decade of additional risk the insurance company didn't price for. Second, policyholders kept their coverage much longer than expected. Insurance companies assumed a certain percentage of people would let their policies lapse. They'd stop paying premiums and the coverage would end. But because people understood how valuable the coverage was, very few let it lapse. This meant insurance companies had to pay out far more claims than they anticipated. Third, the cost of long-term care itself skyrocketed. Nursing home costs have far outpaced general inflation in recent years. A policy that seemed adequate when purchased in 2000 wasn't even close to covering costs by 2015. Those are the reasons most major insurance carriers either stopped issuing new traditional long-term care policies entirely or raised premiums so dramatically that the policies became unaffordable. Today, only a handful of carriers still offer those traditional standalone policies, and premiums are about 26% higher than they were just a few years ago. So if traditional insurance just isn't an option anymore, what are you supposed to do? Well, let's look at the 3 main alternatives. Chapter 2. Option 1, irrevocable trusts for Medicaid asset protection. The first alternative is using an irrevocable Medicaid asset protection trust, often called an MAPT. This is a sophisticated estate planning strategy, but it can be incredibly effective if you plan far enough ahead. It works by creating an irrevocable trust and transferring assets into it, typically your home and your investment accounts. Once those assets are in the trust, they're legally no longer belonging to you. You've given up control over the principal, which means you can't just take the money back out whenever you want. But because you no longer own those assets, after a certain waiting period, they're not counted when determining your eligibility for Medicaid long-term care benefits. Medicaid has strict asset and income limits to qualify. In most states, you can only have about $2,000 in countable assets as a single person. If you have more than that, you're expected to spend those assets down before Medicaid will help pay for your care. A properly structured irrevocable trust allows you to preserve assets for your heirs while still qualifying for Medicaid to pay for your care. You can typically retain the right to live in your home if that's in the trust, and you can receive income generated by the trust investments like dividends or interest, but you cannot touch the principal. Now here's the critical part, the timing. Medicaid has what's called a look-back period, and it's generally 5 years for long-term care. This means when you apply for Medicaid, they review all transfers you made in the previous 5 years. If you transferred assets for less than fair market value, like putting them into an irrevocable trust, this can trigger a penalty period during which Medicaid won't pay for your care. So if you think you might need care in the next 5 years, an irrevocable trust might not help you. But if you're planning ahead and you're in your 50s or early 60s and you're thinking about retirement, this could be a very powerful strategy. Chapter 3, Option 2, self-insurance when your estate is large enough. The second alternative is self-insurance. This is exactly what it sounds like. Instead of buying insurance or using Medicaid planning strategies, you simply plan to pay for long-term care costs out of your own assets if and when you need care. Now, this isn't a viable option for everyone, but if your estate is large enough, self-insurance can actually be the most flexible and cost-effective approach. Now, here's the math. As I mentioned earlier, a private nursing room can cost an average of about $128,000 per year nationally. So let's assume someone needs care for 3 years. That's about $380,000 in total costs, not even accounting for inflation. But when we remember 70% of people who reach age 65 will need some type of long-term care, that doesn't mean 70% will need 3 years in a nursing home. Many people only need care for shorter periods, or they'll need less intensive care like assisted living or maybe in-home care. So if you have a portfolio of $3 million or more, the risk of long-term care costs depleting your entire estate is actually relatively small, especially when you consider that you likely won't need the most expensive type of care for the longest duration. Imagine a couple with $4 million in investment assets. They're both 65 and reasonably healthy. They estimate they need about $150,000 per year to maintain their lifestyle in retirement. And they expect Social Security to cover about $50,000 of that. So they need $100,000 per year from their portfolio. Using a conservative withdrawal strategy, their portfolio should sustain them comfortably through their 90s. But they're concerned about long-term care costs. What if one or both of them need nursing home care? Well, let's stress test it. Let's assume the absolute worst case scenario where one spouse needs 3 years of private nursing home care at almost $130,000 per year. That's about $390,000. Yes, that's a significant expense, but it's less than 10% of their total portfolio. Even after paying for that care, they'd still have well over $3.5 million remaining. Now, could both spouses need extended care? It's possible, but with $4 million in assets, they could absorb those costs without risking their financial security. And at the same time, they're not paying an annual insurance premium that could run $5,000 to $15,000 per year or more. Over 20 or 30 years, those premiums add up to hundreds of thousands of dollars. Self-insurance generally starts to make sense if you have a net worth of $3 million or more and you're comfortable with your retirement income plan even after accounting for potential long-term care costs. It's actually very attractive for people who want to maximize their flexibility and aren't worried about leaving a specific inheritance amount. Chapter 4, Option 3, hybrid policies with long-term care benefit rider. The third alternative is hybrid life insurance policies with long-term care riders. These have become increasingly popular as traditional long-term care insurance has disappeared. Here's how hybrid policies work. You purchase a permanent life insurance policy, usually a whole life or a universal life policy, and you add a long-term care rider to it. Now, this rider allows you to access the policy's death benefit early to pay for qualifying long-term care if you become chronically ill. Let's say you purchase a $250,000 whole life insurance policy with a long-term care rider. If you never need long-term care, your beneficiaries will still receive the full $250,000 death benefit when you pass away. But if you do need care and you meet the policy's benefit triggers, which is typically needing help with 2 or more activities of daily living like bathing, dressing, or eating, you can access that death benefit to pay for care. Many of these policies allow for you to access 2 to 4% of the death benefit per month for long-term care expenses. So with that $250,000 policy at 4% per month, you could receive $10,000 monthly for long-term care. That would last about 25 months or just over 2 years. The big advantage here is that you're not throwing money away. If you never needed long-term care, your premiums weren't wasted. Your beneficiaries will still get the death benefit. This eliminates that use it or lose it problem with traditional long-term care insurance. First, the upfront cost can be substantial. A single premium hybrid policy might require $50,000 to $150,000 or more depending on your age and the benefit amount. It's a large chunk of capital that's now locked into an insurance policy instead of remaining invested in your portfolio. Second, you get less long-term care coverage per dollar compared to those traditional policies. Because the insurance company has to fund both a death benefit and long-term care benefit, you're not getting as much pure long-term care coverage as you would from a standalone policy. Third, every dollar you use for long-term care reduces your death benefit dollar for dollar. If you use $150,000 of your $250,000 death benefit for long-term care, your beneficiaries only receive the remaining $100,000 when you pass. Families expecting a specific inheritance can be surprised when long-term care really erodes that payout. Fourth, the cash value component of these policies is typically very weak. These policies are not designed to build significant cash value. If you need to access cash or cancel the policy early, you'll likely face surrender charges and you won't get back what you paid in. Fifth, and this is a hidden cost many people miss, you have to qualify medically for these policies. If you already have health issues or you're already having difficulty with activities of daily living, you probably won't be approved. Finally, we have to watch out for inflation risk. A benefit that seems adequate today might not be sufficient 20 or 30 years from now when you actually need care. If nursing home costs continue rising at 7 to 10% per year, a $10,000 monthly benefit today might only cover half of what care costs in 2045. These policies work well for people who want multi-purpose protection. Maybe you have $1 million to $3 million in assets, you want some life insurance for your spouse or your children, but you also want to protect against long-term care costs. You're comfortable locking up a significant lump sum, and you like the idea of guaranteed premiums with no future increases. Hybrid policies can make sense in that situation. But if your primary goal is maximizing long-term care coverage, or if you want maximum flexibility with your capital, a hybrid policy might not be the best option. Chapter 5, understanding the real numbers behind long-term care. Before we talk about how to make the decision between these three options, let's make sure we're working with accurate numbers. Because the financial impact of long-term care isn't just about the 70% statistic, it's actually about understanding what that means for you. Here are the costs you might need to know as recently as 2025. A semi-private nursing home room, it costs you around $111,000. A private nursing home room, a little less than $130,000. Assisted living facilities, around $70,000 a year. A home health aide, which is full-time, might be about $80,000 per year. And an adult daycare might be about $26,000 to $30,000 per year. Now, these are national averages. Costs vary dramatically by location. In Alaska, a semi-private nursing home room runs over $31,000 per month, while in Texas, it's closer to $5,600 per month, a huge difference. Chapter 6, making the decision. 3 key factors. So how do you decide which of these 3 alternatives is right for you? It comes down to 3 key factors: your health history, your asset level, and your care preferences. Let's start with your health history. Your current health and your family health history should be heavily influenced on your decision. If you're currently in your 50s or early 60s and you're in excellent health with no chronic conditions, you have all 3 options available to you. You could establish an irrevocable trust, you could pursue that hybrid policies, or you could plan to self-insure. But if you already have health issues, diabetes or heart disease, or you're already having mobility problems, you're probably not going to qualify for that hybrid policy. The underwriting is based on your health, and insurance companies don't want to insure people who are likely to need care soon. Your family health history also matters a lot. If both your parents needed extensive long-term care, if Alzheimer's or dementia runs in your family, you're at a much higher risk. That might make you more inclined to pursue protective strategies like an irrevocable trust or a hybrid policy rather than self-insuring. The second factor is your asset level. This is probably the most important consideration. If you have less than $1 million in total assets, self-insurance probably isn't realistic. Long-term care costs could devastate your entire estate plan and leave your spouse with insufficient assets. In this range, you should seriously consider either a hybrid policy or an irrevocable trust, depending on your timeline and goals. If you're between that $1 million and $3 million in assets, you're in the middle ground. You might be able to self-insure, but it would take a significant bite out of your estate. A hybrid policy could make sense here, or an irrevocable trust if you're willing to give up control of some of those assets and you're planning far enough ahead. The third factor is your care preferences in your family situation. Where do you want to receive care if you need it? Do you want to stay in your home? Would you be comfortable in an assisted living facility? Do you have family nearby who maybe could provide some support? If staying in your home is your top priority and you have family who can help, your long-term care costs might be relatively modest, so just paying for a part-time home health aide might be the right option. In that case, self-insurance might be sufficient even with a smaller estate. But if you know you'd want or need facility-based care and you don't have a strong family support network, the cost can be much higher. That might push you towards those more proactive strategies. Long-term care planning is one of the most important and most overlooked aspects of retirement planning. With a traditional insurance no longer being a viable option for most people, you need to be proactive about evaluating your alternatives. Whether it's an irrevocable trust to protect assets for Medicaid, self-insurance when your estate can absorb the cost, or a hybrid policy that provides dual benefits, each strategy has its place. The key is understanding which approach aligns with your health, your assets, and your goals. If you'd like help evaluating your long-term care options as part of a comprehensive retirement plan, I'd encourage you to reach out to a qualified financial advisor who can walk you through these scenarios. Don't wait until you're already facing a health crisis. The best time to plan for long-term care is right now, when you're healthy and you have options. If you want to explore which of these options might be the most effective for your situation, I've put a link to schedule a call with our team in the description. We can have a straightforward conversation about where you are and whether working together makes sense.